Hi, good morning everybody, and welcome back to the channel. Today I thought we'd go ahead and talk about a topic where this is, depending on who you ask, they're going to tell you it's not possible to retire with this much, or that it would be, you need at least $1 million to retire, you need 5 million, you need 10 million. Here's the thing, I hate putting an arbitrary number because everybody's circumstances are different. You might say $500,000 is nothing. You live in a high cost of living area. Let's say you're needing 2-3 million and you think you need that much. But I also want to talk about the possibility of, let's say, earning a six-figure income from a relatively small portfolio compared to what you think you might need. And this is going to be through what's called the options wheel strategy. Now, if you've never heard of the options wheel strategy, what this is it's a way for you to earn income by doing cash secured puts and also covered calls. I will leave this link in the description because I believe this can be very powerful. And we're going to go over an example. You'll see that I had Coca-Cola stock pulled up. And I want to go over this because you'll see this number, $4,000. I want to explain what this means and kind of go over, hypothetically, a $500,000 portfolio. What kind of income could you realistically be looking at if you played your cards right with the wheel strategy? And obviously, you're going to want to be diversified. We're not talking about putting $500,000 into Coca-Cola stock alone, especially in retirement. But the focus for this is going to be blue chip dividend stocks, blue chip companies that have been around for a long time and that pay regular dividends, ideally are increasing those dividends. And then you can also kind of come in and maybe earn some of those dividends while implementing the wheel strategy. So that's kind of the goal with this. And what we're going to be really focusing on here is making sure that we're continually getting options premiums credited into our account, because that's going to be paramount to this strategy. And so if we can figure that on a $500,000, we would need at least 20% to earn over $100,000 or a six-figure income, then that's what we need to shoot for. Now, 20% may sound crazy, but remember, we are doing this on a trading basis. And so if you actually do the research on option strategies, you can look at the tax implications of this too. But the main thing to consider here is that 20% may seem kind of crazy. Well, Warren Buffett might do 20%, but what makes you think that you can earn 20%? I'm not saying that you're necessarily going to earn a specific percent from this, but there are people, if you ask a lot of options traders who do this on a regular basis, there are ways to earn those types of returns. You can earn, let's say, 1 to 3% returns on a monthly basis, even more, maybe sometimes even 4 or 5%, depending on the risk tolerance of yourself and all of that kind of stuff. But basically how the wheel strategy works is it's an approach that involves selling cash secured puts until you get assigned the stock, and then turning around and selling covered calls until the stock gets called away. So basically what we're doing is when we buy a stock like Coca-Cola, we're going to enter into what's called a cash secured put trade. And this cash secured put trade is going to be such that we are going to get a premium from doing so. And so every time we buy Coca-Cola stock, we're going to get this premium. In this case, 71 contracts is what we're working with, or 7,100 shares. That's at $72 a share. So let's do the math on this. It's probably going to be a little bit more than if we look at, let's say, 72 times, 7,100 shares is going to be $511,000. So roughly $500,000 is what we're working with at a strike price of $72. And this will make more sense in a minute. But what we're doing is first selling a cash secured put and then selling a covered call once we've actually done the cash secured put side of things. And so it's a continual cycle, a repeating cycle, where we're trying to earn as much income as possible. Now, the expiration for this is September 13th, 2024. The thing to keep in mind is that our max gain on this is going to be the $4,000, as you'll see, minus the commission. The commission itself is $46.15, which gives us this number of $4,000. So today is September 2nd, and if we look at this from the September 13th expiration, we're agreeing to buy Coca-Cola stock over $500,000 worth at $72 per share. And remember, you want to be well diversified while doing this strategy. You wouldn't want to do this against one single stock, right? But the goal is we're going to continue to be doing this to collect as much options premiums as possible. So you can go out a couple weeks. You could try to look at a monthly option expiration. What I have noticed is that the options premiums for Coca-Cola right now are higher on a weekly basis relative to, like, say, going out a month. And so you're actually going to be better off selling one, say, 2 weeks out roughly. So September 2nd, today's Monday. If we go out to next Monday, that would be what? 3rd, 4th, 5th, 6th, 7th, 8th, the 9th, right? And then we go up to the 13th, 10th, 11th, 12th, 13th. So that's not quite 2 weeks, but we can kind of say to ourselves, okay, we're collecting $4,000. Here's our max loss, $507,000. That's because we're putting up $500,000 in capital. And it's basically saying, well, if Coke went bankrupt tomorrow, which is extremely unlikely, right? And let's say the stock went to zero, that's how much you would lose, which is not going to happen. And the reason for this, though, is because we're agreeing to buy the stock at 72. So our max loss is technically, in this case, going to be factored into the idea that Coke goes bankrupt and we lose everything up until September 13th, right? So we're locked into this contract once we do this. And that's the trade-off, too. It's almost like signing on the dotted line because we're basically agreeing to put up our $500,000 as collateral. In exchange, we're going to buy Coca-Cola at $72 a share and hopefully collect some massive premiums in the process. And hopefully that's going to get us above 6 figures. So that's the whole idea with this. We sell cash secured puts. We go ahead and we choose a stock with solid fundamentals. Okay, we want to look at, your risk tolerance and your own investment objectives. You want to buy or choose a price, a strike price, the $72 one in this case, that you would feel comfortable owning the stock at. And the idea is, a lot of times what you're going to see is you want to purchase it at a discount. Now, in this case, for Coca-Cola, the stock is actually trading at, I think, a little bit above, so 72.47. However, the stock does have, about 11 days to move in that direction because the expiration is on September 13th, 2024. So we're buying it at a slight discount, or we're agreeing to. We're signing on the dotted line up until September 13th, 2024 with that $72 strike price. So we're agreeing to buy 7,100 shares at that price. Now, we can kind of take a look here at the shorter term chart, and you'll see that Coke is up. Okay, so if we look at this from, it's been on an uptrend, and so the idea is, let's hope Coke does not go below 72, because if it doesn't, then we can just repeat the strategy again and make more money. And so that's, once again, the first step. Then what we do is once we actually get long the stock, let's say the stock comes down from $72 a share. Okay, so in this case, it's trading down to 70. Now we're long the stock, but Coke's such a massive company. We expect them to be around for a long time. We're not really concerned about the share price too much. So even if we have to buy Coke, it's such a high quality company, why not? And so the idea here is that even if Coke goes down to 60 or 65, we can still collect a dividend since they've been raising that dividend for quite some time. Right now, the yield's under 3%, but Coke is such a large company, we're hoping that the dividends continue to be raised every year, right? So every quarter, you're going to get nearly 50 cents. And so this is also going to factor into the passive income equation. And the goal, I think, with this would be to really focus on how can I build a portfolio of 10, 15, 20, or even more stocks, depending on like how much time you have to research everything. Because this could be something you do in retirement where, and this is kind of what I'm going for too, is how do I do this against high quality companies and how do I earn that cash flow that would allow me to, let's just say, retire early, without having to have a massive multi-million-dollar portfolio, because I've seen these figures thrown around. And if you do the math on, let's say, 11 days divided by, $4,000, how many days are there in a year? 365, so divided by 11. It's a very simplified example. There's going to be a lot of factors to consider, but 33, right? So 33 is going to be your factor here times 4,000. So assuming you did this, even just to be conservative, let's say 30 times in a year, you did this trade or multiple trades on multiple different stocks throughout the year, you could be looking at, in this case, 30 times 4,000, $120,000 a year income. Now, that's just on the cash secured put side and also the covered calls. So the step 2 you'll see here is like holding and collecting dividends. So if the stock price drops below the strike price before the expiration day and your put option is exercised, you can then buy the stock and then you can also collect the dividend, right? Any kind of dividend it pays. You could also choose a strike price and an expiration day that is out of the money, and then one that actually is past the ex-dividend day. So then you have a better chance of collecting that dividend. And then if your shares get called away, in the case of a covered call, we'll get into that next, selling covered calls, because that's the next step. But you could also just collect that dividend in the process and then sell your position through a covered call, right? Or put up your position, sign on the dotted line, agreeing to sell your shares now. Instead of buying shares in Coke, we're going to be selling shares at an agreed upon strike price. So we're going to enter into that contract again. And what's going to happen is, so after acquiring the stock, the next phase is to move into selling covered call options, which involves selling a call option on a stock you already own. So once again, getting back to the premiums, we're collecting premiums on a regular basis from this strategy while also mixing in some dividends, holding those dividends, collecting those dividends. And so that is the beauty of this. Once again, you don't need as much as you think. If we actually run the numbers, then we can say, hey, let's try to do this against all of our portfolio 25 to 30 times a year. You're probably going to be looking, depending on the strike prices you choose and how much in dividends you can also rack up, $100,000 is not totally unreasonable. And as I just explained, we're actually being a little bit conservative because this is 11 days after expiration. And of course, there's a lot of different factors in the market to consider. This is not just black and white. But if we look at this from that perspective and like what kind of premiums you can get across a wide variety of dividend stocks, then it does, in fact, I think, become realistic to see those types of yields. And even if you look at some of the options covered call ETFs that I've explained on this channel, if we look at, for example, JEPQ. Now, this one was over 11%. I want to say it's still, so over the last year, I think this ETF is up. You have a positive share price return, but also it's factored into the total return. You have nearly a 10% dividend yield. That's, if you do that on a monthly basis, it's not quite 1% per month you're getting. But keep in mind, you're also getting the share price growth in terms of this as well. So it could be that you're making money on the upside as well with this strategy, with the stocks that you're buying. Like if you trade these correctly and you factor these things in, you could perhaps also plan to make money from the upside in these stocks, or at least make some on the spread from the covered calls and the cash secured puts you're going to be selling. But this is an example of an options ETF that pays on a monthly basis and pays nearly 10%. So that on a $500,000 portfolio would be nearly $50,000. So that's like half the equation right there. Another example of how you could go about doing this. But if you actually wanted to do it by yourself, this is how you could go about doing it. So then the next step, coming back to covered calls, just like selling cash secured puts, except on reverse, or in reverse. So we're going to do the same number of shares here, 71 contracts, which is roughly $500,000. We're going to switch it to the call side, okay? The call option side is September 13th. Let's do the same expiration, but this time, since the stock's already at 72.47, we'll just say that we already bought the stock. We already own the shares in this case because our cash secured put went in the money. And now we're actually going to go ahead and buy or sell a covered call at the price of 33 cents. And with that same expiration of September 13th, we're still looking, and this is the variability of it too. You have to keep in mind, this is variable, but we're trying to do consistent cash flow in retirement with, in working with less. We don't have a multi-million-dollar portfolio. We're not just sitting back and collecting a dividend check. We're going to be a bit more proactive. But we're going to go out, we're going to turn this into maybe our retirement hobby, or one of them, where we're actually researching the market. And it's a hobby, but it's also paying for our livelihood in retirement. So what we have here is a situation where you can take less than you think. You can work with less. And you can take this, let's say $2,296 times, if we assume we're going to be able to do these trades every 2 weeks, right there, that's $57,000. Not quite six figures, but the thing to keep in mind with this strategy, if we were to choose, so let's say we sold the cash secured put at 72 and we didn't care about any upside on the stock. So we said, okay, we're going to go ahead and instead of getting $2,000, we can go back to 72. If we sold the cash secured put at 72, right, we bought the shares. Well, now let's say Coke went up a little bit and we're actually in the money. So here's another example of where you could get a very favorable amount of cash flow, where in this case we're collecting over $6,000 just from this one trade. So this is like, okay, now my bills are paid for the month. Even if I do this twice a month, that's even better, because now my bills are paid, and I'm also just making a lot more by going a little bit more in the money. I'm not getting money on the share price gains because I sold my cash secured put at first at 72. Coke, let's say, went up a little bit. But now I'm selling at the same strike price for this trade. I'm locking in this trade and getting over $6,000 on this one example. And so then if you do that 20 times over the course of a year, even being even more conservative, I said 30, now 25, or 20 trades in a year, you're looking at $125,000 just from that. So once again, that's over $10,000 a month. Is this realistic? I think so. I think this is something that I've researched this a lot myself. You have to be proactive. You have to really, I think, build your own portfolio and research these things. I think there's a lot that can go into it, but I think absolutely it's possible. And one thing with options that I love, and the options wheel strategy, we've gone through each three of these steps. So we're going to sell cash secured puts, hold and collect those dividends when we can, because we're doing this against dividend stocks. And then we're going to sell covered calls. And even if we don't make money on the share price, at least we can try to make as much as possible from the premiums and the cash flow coming into our portfolio. With that being said, we can do this, and I had something else I was going to discuss, but I kind of lost my train of thought. Hopefully it comes back to me. But I want to kind of wrap up here. And what it comes down to is, I think, just doing this consistently and researching this stuff and being proactive. I think that's what we were talking about in terms of being proactive and just really understanding how this works and how you can potentially work this into your favor. And so I hope to post more content on options trading. And the one other comment that I just thought of that I was going to mention is the casino analogy. So when you think about options trading, the thing to keep in mind is that there's buyers and sellers. In this case, you're the seller of both call options and put options against your portfolio, and you're earning income in the process. So you are the house, you are the casino, with somebody who is buying options, buying call options, buying put options. They are more of the gambler in that case. Why? Because they're trying to bet on a big move in the stock price. So the idea is, if we can sit back against low volatility, dividend-paying stocks and get consistent premiums into our account, we are kind of like the house. Because even if we lose a trade, worst case, we're going to get long and buy a high-quality company. Or worst case, we have to sell our shares and, let's say, break even on a trade. And the volatility is such that a stock like Coca-Cola, sure, it's going up in price, which is probably a good thing. Maybe we can catch some of that upside while doing this as well. But even if it goes down, you're probably not going to have as much volatility. And in fact, the S&P 500, using that as a relative example, the beta of Coca-Cola, which is a measure of volatility against the index or the S&P 500, is only 0.6. And so that makes it even more appealing because our volatility and our risk is lower, which is what you want in retirement. So hope this helped. Hope this was something you guys can take away for cash flow retirement. Once again, the reason I made this video is because I feel like there's so much out there that says, well, you know, retirement is so expensive these days. You have to have millions of dollars. You have to have this, that. But maybe not necessarily. Maybe you're holding back on retirement because you think you need to save a bunch more. The kids are out of the house. Maybe you're younger. Maybe you want to retire young and you're thinking, well, maybe it's not so unrealistic. Maybe I can do this. Because when I think of retirement, I don't think about necessarily stop working entirely. I think about what can I do more that I enjoy. Maybe what hobbies can I do. Maybe this could be one of them. Maybe I could actually research the market and find trades to put on with cash secured puts and the wheel strategy that would pay for somebody's lifestyle, let's say, or somebody's ability to earn cash flow to where they don't necessarily have to go into a corporate 9-to-5 job at a specific location. And so that's kind of the idea here, guys. Maybe we can retire early. Maybe not all hope is lost. Maybe there are opportunities out there if we change our mindset and we actively look for them. Thank you so much for tuning in, guys. God bless. I hope you have a great Labor Day, and we will see you in the next one. Take care.